All right, so let's get right into it. Today we're talking serious financial wisdom and, in a way that actually respects your time. We're going to explore some ideas from Benjamin Graham. He's someone that Warren Buffett thought was just about the smartest guy he ever knew, second only to his own father. Now, Graham wasn't just some Wall Street guy. This was a guy who wrote plays for Broadway, even translated novels, just to give you a sense of the kind of mind we're dealing with here. But you know what really made him stand out? It was his ability not only to survive market crashes like, the big one back in 1929, but to actually do better than the S&P 500, like consistently by at least 2.5 percentage points every single year for over 20 years. That's the kind of record that earns you the title of legend. So what was his secret? It wasn't just about numbers. Graham really brought together 5 incredible strengths. We're talking intellectual horsepower, financial know-how, deep understanding of psychology, history, and a knack for writing. So let's start with his brain power. This guy was offered to be a professor in English, Greek, and Latin, and math, all before he even finished college. And we're talking 20 years old. Talk about a Renaissance man. But Graham, he didn't just want to, stay in his ivory tower. He took his genius and applied it to finance. Became a master investor who consistently beat the market. And he didn't just ride the wave. He saw the crashes coming, issued warnings that really showed his insights were timeless. Now here's where it gets really interesting. Graham was ahead of his time in the way he understood human behavior. He knew it wasn't just cold logic, it was emotions that drive investment decisions. He was already thinking about ideas that later won Nobel Prizes for economists who were studying behavioral finance. Basically, he understood how our own psychology can mess us up when it comes to money. And this wasn't just some random insight. Graham was a student of history. He saw how these financial booms and busts, they kept repeating themselves over and over again throughout time. He knew to avoid making the same mistakes and maybe even see opportunities coming. You got to learn from what happened before. Does history repeat itself? Well, Graham, he definitely thought so. And then to top it all off, Graham was an incredible communicator.
He made these complicated financial ideas easy to understand by writing clearly and using memorable examples. Like he used this analogy of Mr. Market to illustrate how irrational the stock market can be. He imagined it like this moody guy who offers you prices every day. Sometimes they're ridiculously high, sometimes they're ridiculously low. The point is, don't let Mr. Market's emotions control yours. He even made it sound kind of fun. So we've seen that Graham wasn't just a brilliant mind. He was a master investor who blended smarts, psychology, and a deep understanding of history. But what were the actual principles that shaped his whole investment philosophy? That's what we're going to dig into next. Stick around, because this is where it gets really good. Okay, so we've gotten a glimpse of just how brilliant Benjamin Graham was. This guy who could have been a professor in I don't know how many fields, but chose Wall Street. But how can you actually use his wisdom in your own financial life? Well, let's break down some of his core principles, starting with this really fundamental difference between investment and speculation. For Graham, investing wasn't about, gambling or chasing the latest hot tip.
It was all about careful analysis, aiming for the safety of your principal and a decent return. Anything else he considered speculation, basically a risky bet that, might pay off or could just as easily whack you out. So step 1, know the difference and make sure you're really investing, not just playing roulette with your savings. Now, when Graham talked about investing, he wanted people to think like owners, not just, stock tickers. He really believed that buying a share of a company meant becoming a part owner in that business. It's this long-term mindset that encourages you to look past those short-term market swings and focus on the company's fundamentals. Things like their earnings, their assets, their management. It's like you're building something, not just flipping a piece of paper. But Graham also knew that not all investors are the same. She outlined 2 main approaches, defensive and enterprising. The defensive investor, pretty self-explanatory, right? They're all about minimizing risk and effort. Sure, want steady returns without having to constantly watch the market. Thinking index funds, blue chip stocks, that kind of thing. The enterprising investor, on the other hand, they're willing to put in the work. They're actively looking for those undervalued companies, the hidden gems that everyone else is overlooking. It's kind of like treasure hunting takes more effort, but the rewards can be a lot bigger. And speaking of hidden gems, that brings us to one of Graham's most famous ideas, the margin of safety. Imagine you're buying a used car. You wouldn't just pay the sticker price without checking it out first, right? You want some wiggle room just in case there's some hidden problems. It's the same with investing. The margin of safety means buying stocks for less than their intrinsic value, what you believe the company is really worth. This gives you a cushion to protect you even if your calculations are a little off or the market takes a sudden dip. But Graham didn't stop there. He thought investing should be treated like running a business. You need a systematic approach to maximize returns and minimize losses. Just like a company, you need a plan. You got to track your performance. You need to be ready to adapt as things change. It's not about luck. It's about making smart choices based on solid principles. And last but not least, Graham was a huge advocate for independent thinking. He told investors to develop their own judgment based on data and reasoning instead of just blindly following the crowd. Remember Mr. Market. Well, sometimes the crowd gets caught up in Mr. Market's mood swings, and they make some pretty irrational decisions. Graham believed that real success comes from sticking to your own well-informed beliefs. So we've covered a lot here, but hopefully you're starting to see how powerful and practical Graham's ideas really are. These aren't just some abstract theories, they're battle-tested principles that have helped generations of investors become successful. But let's get specific. How did Graham actually put these principles into practice? What techniques did he use to find those undervalued companies? Stick with us because in the next part we'll dive into the tools and strategies that made Graham such a legendary investor. Okay, so we talked about Benjamin Graham's big picture philosophy, thinking like an owner, knowing the difference between investing and speculating and always looking for that margin of safety. But how did he actually go about finding these hidden gems in the market? What were some of the techniques he used to uncover these undervalued companies? Well, one of Graham's classic strategies was to look for what he called net nets. And imagine a company where the stock price is so low that it's actually worth less than the value of its liquid assets. So basically the cash it has on hand minus any debts. It's like buying $1 for 50 cents. Now these opportunities, they don't just, fall out of the sky, but Graham proved that they do exist. You just got to do the research. He'd really dig deep into those financial statements looking for companies that the market was overlooking. I just didn't understand. But he wasn't just looking for a bargain. Graham was a master at analyzing financial statements. He really believed in understanding a company inside and out before putting in a single dollar he'd pour over those balance sheets, income statements, cash flow statements, looking for clues about a company's real worth for it, the things that the market might be missing. Another tool Graham used was something he called cigar butt investing. And now, before you picture him digging through ashtrays, let me explain. He used this analogy to describe companies that might be past their prime, but still had, one last puff of value left in them. Maybe they had undervalued assets, a strong brand name, a loyal customer base, something that could be unlocked with the right strategy. Graham believed that if you could identify these overlooked companies and buy them at a discount, you could get some pretty impressive returns, even if they weren't going to be the next, high-growth stock. It was all about finding value where others saw nothing. But Graham wasn't just about finding undervalued companies. He also knew how to manage risk. He understood that, no investment is foolproof, and he came up with strategies to protect his money even when the market was going crazy.
One of his most important risk management techniques was diversification, basically spreading your investments across a bunch of different assets, industries, sectors, so you're not putting all your eggs in one basket. This helps to reduce your exposure to any one company or event. If one investment goes bad, it won't wipe out your whole portfolio. And of course, we can't forget about that margin of safety discount. Graham saw this as absolutely essential for minimizing losses and maximizing gains over the long run. It's like creating a buffer so that even if your analysis isn't perfect or the market throws you a curveball, you're still protected. So the question you might be asking is, did all this actually work? And the answer is, well, yeah, it did. Graham's investment record was legendary. He consistently beat the market. He survived some of the craziest periods in financial history, like the Great Crash of 1929. And his success wasn't just dumb luck. He taught these methods to generations of investors, many of whom became incredibly successful themselves. Warren Buffett, probably his most famous student, often says that Graham shaped his whole investment philosophy and guided him to a lifetime of beating the market.
So what's the big takeaway from all of this investing? Isn't just about getting lucky. It takes skill, it takes discipline, patience, and a willingness to do the work. It's not about chasing trends or getting caught up in hype. It's about understanding value and making smart decisions based on solid principles. Graham's methods might seem a little old school in today's world of high-frequency trading and algorithms, but his core principles, they never get old. In fact, in a market that's often driven by short-term thinking and emotional reactions, his focus on rationality, value, and risk management is more important now than ever. So as you continue your own investment journey, remember what Benjamin Graham taught us. Seek out value, manage your risk, and never stop learning. The market can be unpredictable, but with the right mindset and a strong foundation of knowledge, you can achieve your financial goals and build a portfolio that will last. And that brings us to the end of our deep dive into the incredible world of Benjamin Graham. I hope you found his insights as valuable as I have, and if you're looking for more thought-provoking discussions and practical tips on finance and business, Don't forget to hit that subscribe button. We're always exploring new ideas and sharing strategies to help you succeed in the world of investing. Thanks for joining me, and until next time, happy investing.